The market tone today was all about sequence, not noise. We got macro data, we got flow data, and then we watched how traders reacted when both hit at once.
Exactly, and the timestamp matters. At 8:30 a.m. Eastern, the US CPI print came out, and that immediately reset the short-term rates conversation for every risk asset, including crypto.
The Bureau of Labor Statistics showed headline CPI up 0.2% month-over-month and 2.4% year-over-year, with core at 0.3% month-over-month and 2.5% year-over-year.
On paper, that's not a panic print, but in this regime, crypto is still trading as a liquidity-sensitive asset class. So the market response is less is inflation solved and more does this change the timing of easier policy.
And when traders think the path to easier policy is slower, discount rates stay heavier, and weak positioning gets exposed fast.
That's why today was a stress test of conviction. Not a story day. A positioning day.
Then came the second pressure point. Morning ETF flow publications showed another risk-off pulse, with spot Bitcoin ETFs around negative $410 million and spot Ether ETFs around negative $113 million.
When those outflow numbers show up while sentiment is already in extreme fear territory, you're basically watching a live referendum on whether de-risking is done or still unfolding.
Here's the key learning for investors. Price can bounce for many reasons, but sustained recovery usually needs better capital commitment quality.
Exactly. A green candle is not the same thing as confident money returning.
If outflows remain heavy, sharp rallies can still be exit liquidity.
If outflows slow while price stabilizes, that's the first hint that forced selling is running out.
Now let's move to company-level signal, because this is where narrative got complicated today.
Coinbase released results commentary highlighting all-time highs in multiple 2025 metrics, including total trading volume, subscription and services revenue, and paid Coinbase One subscribers.
The company framed that as product diversification and operating discipline, and strategically that matters.
But on the same tape, post-earnings commentary from the street focused on near-term misses and estimate resets. So the market had to process two truths at once.
Truth 1. The platform is becoming broader and less single-cycle dependent over time.
Truth 2. Quarter-to-quarter earnings are still highly exposed to volatility, activity mix, and risk appetite.
Investment takeaway here is huge. Structural progress and short-term earnings pressure can coexist.
If you can't separate those timeframes, you'll keep misreading both rallies and drawdowns.
Another hotspot today was the institutional on-chain storyline. Earlier this week, Uniswap surged after BlackRock's tokenized treasury fund BUIDL became tradable there.
But the market then gave back much of that move, and that reversal is not just a chart detail. It tells you regime beats headline when fear is dominant.
In a risk-on regime, adoption news extends.
In a fear regime, traders often use good news to reduce exposure.
That's why event-driven investing requires context ranking. Same headline, different regime, opposite price behavior.
We also got an exchange structure event that matters more than people think. Binance delisting batch hit today, including tokens like ACA and several other lower liquidity names.
Delistings are not just admin updates. They can trigger liquidity migration, slippage spikes, and repricing in connected pairs.
Especially when macro is shaky, these microstructure events can amplify volatility in places that look unrelated at first glance.
So if you're learning one framework from today, use this. Macro impulse, institutional flow, and venue mechanics can stack.
And when they stack in the same direction, short-term narrative changes fast.
Now let's bring in influential voices, because this was a mandatory part of today's debate, and it genuinely mattered.
At Consensus Hong Kong, Tom Lee said investors should focus on opportunities rather than trying to perfectly time the bottom.
That sparked debate because people heard, "buy the dip," and assumed it was a short-term call.
But his core framework is horizon-based. If your thesis window is long, extreme volatility is a feature, not an automatic thesis break.
Then you had Michael Saylor on CNBC saying strategy won't be selling Bitcoin and plans to keep buying every quarter.
That statement also triggered a split reaction. Supporters call it disciplined long-duration accumulation, critics call it regime-insensitive conviction.
Both reactions teach something. Public high-conviction quotes are not trading signals by themselves.
they're framework signals. You still have to map the quote to assumptions, balance sheet constraints, and timeframe.
This is where a lot of investors get trapped. They borrow someone else's conviction without borrowing that person's risk tolerance or time horizon.
Exactly. If your holding period is 3 weeks, don't pretend you're running a 10-year framework.
One more critical context layer from today. Fear was still elevated despite multiple good news fragments.
That tells us market psychology hasn't fully reset. Participants are still asking where the exit is, not where the next expansion leg begins.
Which means any recovery attempt needs confirmation from breadth, flows, and follow-through, not just one intraday squeeze.
Also worth noting, this is not a tape-reading episode. We are not doing line-by-line candles.
Right? We are mapping concrete events to narrative structure and investment knowledge.
And today's structure was clear. Macro print reset the backdrop, ETF outflows tested demand, company earnings complicated the sector story, adoption headlines failed to extend, and exchange-level delistings added micro-stress.
That is at least 5 independent developments in less than a day of market digestion.
Which is exactly why simplistic up or down framing misses the point.
Now let's close with one focused forecast on the hottest asset in this episode, Bitcoin.
Base case, Bitcoin stays range-stressed in the near term, with violent two-way moves, while the market waits for evidence that ETF outflows are decelerating and macro surprise risk is fading.
Key catalysts for stabilization are straightforward. 1. Flow pressure needs to moderate materially. 2. Macro data and policy expectations need to stop repricing against risk assets every few sessions. 3. High beta crypto equities should begin to hold gains instead of fading every bounce.
Invalidation triggers are equally clear. If ETF redemptions accelerate again and Bitcoin fails to hold recovery zones after positive headlines, that would signal distribution is still dominant, not base building.
A second invalidation would be fresh macro shocks that push real rates higher while crypto-specific demand remains thin.
So the framework is not prediction theater. It is conditional analysis, base case, catalysts, and what would prove us wrong.
That mindset keeps you adaptive when headlines are loud and conviction is expensive.
We'll keep tracking concrete events, not recycled narratives, and we'll update the framework when the evidence changes.